Hey there, guys. Welcome to another episode of JB Literacy. This is Jordan, and I appreciate you taking time to watch this video. Today, I wanted to give you guys a demonstration on a few investment tactics or strategies, vehicles, however you want to classify it. Just kind of two separate, distinct forms of investing. And before I even kind of dive into these, I want to just give out a couple of quick disclosures. I want to make sure that you guys understand these are two very, very different forms of investments. They're for different types of people, looking for different objectives with their investments. With one, you're looking at being a little more aggressive. Maybe it's an investment vehicle strategy that a younger person might follow, or a person that makes a little bit more money that they have to be risky with, as opposed to the other, which is for someone who's looking to be a little more conservative with their money, not looking to lose any money, but is willing to sacrifice some upside potential for that safety net of no downside risk of losing their initial principal. So without further ado, the two investment vehicles or strategies, however you want to classify it, with the first one, the more aggressive one, that would be with your traditional accumulation of money over time through, let's say, like mutual fund shares or index fund shares, however you want to call it. There'd be more risk involved because you can lose your principal, but there'd be the potential for a higher reward. And with the other one, it would be a fixed indexed annuity. So basically with that one, there'd be no set downside risk, so you can never lose any principal. But on the flip side, there would be a cap on how much you could earn over time. So they're two different forms of investments, like I mentioned, with the mutual funds, index funds. Again, I'm not recommending any specific ones or anything, but those would be more tailored for someone that has a longer time horizon to invest, who has longer amount of time to make up for any potential losses. And then with the fixed index annuity, that would be probably better suited for someone who might be a little older, or just is a little, weary of the stock market, doesn't want to lose money, and all that good stuff. So today, the scenario we're going to run through is we're going to say that 30 years ago, someone put $10,000 into let's say a mutual fund. They bought some shares of a mutual fund, and then simultaneously they also bought shares of a fixed index annuity. And within both of their investments, the two separate things track the S&P 500. So today we're going to take a look at, first, we're going to look at the S&P 500 costs, the price per share over the course of the start date of the last 30 years. So at the start of 1992, as you can see, it was just over $416. As time has gone on, it has continuously grown, continuously increased in value. I mean, there's been years when it's gone down, obviously, but for the most part, if you look at the historical numbers and figures and whatnot, you will see that the S&P 500 has performed very well. And these numbers are all via macro trends. So if you've ever visited macro trends or have any questions on this stuff, definitely want to check out macro trends. Right here, this is the annual return per year. So starting in 1992, you saw 416, and then that year it grew 4.46%. So as you can see, as you go down, then it's 435 to start the next year. Then it grew 7.06 in 1993. Then you go down to the start of 1994. As you can see, it continued to grow a little bit. Then at the start of 1995, it dipped a little bit because the rate of return dropped a little bit. So if you just kind of correlate, keep going back and forth, you can kind of see how over time the valuation of the S&P 500 shares has fluctuated. And so, over time, as I mentioned, it's just continued to grow and grow and grow. I believe today it was over $4,300. So, anyways, jumping back to what we mentioned previously, to start out, we're looking at the $10,000 investment in the traditional form of investing. So, investing in a mutual fund, $10,000 and were invested on the 1st of January, 1992. Then it grew 4.46%. As you can see, then it was the start of 1993, 10,460. As you can see, it continued to grow. Then it started in 1994. It was worth almost a little over $11,198. And then at the start of 1995, as you can see, the S&P 500 dipped a little bit. So the value went down. Down here, if you can see in 2000, it dropped about 10%. So at the start of 2001, when you come back over, you can see it dipped quite a bit. Almost, actually looks like around $4,000. So that's where the risk comes into play with this type of investment. But as we mentioned previously, for someone with a longer time horizon, they're going to be able to make up for those losses in the long run. So at the end of this, when you kind of go back and forth and continue to take a look, you'll see that it grew to over $100,000 for the traditional investments. Now with this other form of investing, you've got a 10.5% cap on the growth of the S&P 500. So for these years where it goes crazy, like for instance, in 1995, it grew 34.11%. Your account value that is only going to grow 10.5% because that's kind of the trade-off that you're getting. So you'll see on the years like 1994, it dropped 1.54%. But then at the start of 1995, the account value for, this investment vehicle didn't change because there's no downside risk. You can't lose your principal. So, like I mentioned, it's one of those things where you just have to look at where you're at, what you're looking for, what are your objectives as far as, what you're looking to get out of your investments. The second one we kind of discussed is a lot safer, but the first one could be more lucrative in the long term. That's not to say that's always going to be the case, but just in this context, in this specific example here, it just goes to show you, for someone that's younger, and this is without even adding or contributing any additional money into that account. So this was just a little demo for you. If you have any questions, feel free to reach out. Hope you have a great rest of your day. Peace.